Hey guys, Freaky Finance here. This week we're going to talk about Rick's Hospitality. This is what I thought about doing for a while. It's finally getting non-expensive, is how I'd say it. And over time, this company's done quite well for itself. So what exactly is Rick's Hospitality? So it's largely adult nightclub, tuck-in play. So basically it acquires other nightclubs for fairly cheap using its free cash flow, debt, or equity issuance. Now, one of the cool things about these tuck-in plays is that when you acquire a company for 3 to 5 times EBITDA, like these guys do, when your share price is still worth, say, 9 times, you basically get that multiple rolled up into yours. And so it unlocks shareholder value over time. And it has worked for this company. It does a couple other things with its cash. It does buybacks, and it also allocates capital to Bombshells, which we'll talk about, which is kind of like the restaurant side of the business. And in my view, it's the inferior side of the business, and it's one of the reasons why I want a better price on this before I get bigger. Now I do own this one. It's more of a token position, and yeah, it's right here. So I've just started one, and I'm probably going to add to it as it gets cheaper. I'm hoping for a better price over time. It's starting to get weaker, and it's trading more in line with something I'd consider more fair for the price or for the growth that it's had historically. And Tech Planes, I don't know if I've ever did a video on Alimentation or Superior, but I've kind of already explained it. It's just basically you're rolling up the EBITDA of what you're acquiring. Now, the industry is very fragmented, just like alimentation was for gas stations, and just like for propane for Superior, it's still very much, there's no huge winner in this space. It's prime for consolidation. That's what I'm trying to articulate. Before we get into numbers, let's try to get some more background. So, Rick's has quite a few banners. They have baby dolls. They just made a big acquisition to that one in Texas. But you can see here they have quite a bit of banners. Rick's Cabaret, Tootsie's Cabaret, Scarlett's, there's your Bombshells restaurant side. Now I'm more excited about the nightclub segment. To me, it's just a better business. At least that's how it looks like on paper. And so far it looks like it's a superior business in the current environment as well, which means that it's a better business in a more recessionary pullback environment than, say, the restaurant business looks like it is. Now that could be premature to say, but based on the last 2 years, it's very obvious that the nightclub business is superior, at least to me. CEO might disagree, and maybe that's why they're still allocating a decent amount of their resources to Bombshells, but I find the nightclub business far superior. And I will say that over and over again, probably this call, because it's true, at least in my eyes. The nightclub segment, so they do have ATM commissions in there as well. Obviously, you have your dancers in there, though on the financials, we're going to notice that service margins look very high. And then on the Bombshell side, you got more food as a percent of the business, and we'll go through it pretty quickly. They do have some exposure here to large outdoor patios. It's largely in Texas. I guess we should talk about the footprint first. So you can see Bombshells pretty much all in Texas, whereas the nightclubs are fairly spread out, but again, very concentrated in Texas. So for our purposes, I'd say it's very much still a Texas play in terms of locations, but in terms of revenue, it's a little bit more spread out because some of the bigger clubs are outside of Texas. So I find this chart very useful because I think it helps kind of drive like where the business is. So you can see Bombshells in blue is all in Texas, and then you have these large clubs, one in Texas, and a huge one in Florida, bigger ones in New York, and you can see the clubs are more spread out. So I just find this footprint interesting if you guys wanted to pause it and look at it. And the properties, it is kind of interesting because they do own the properties, and they have a history of making acquisitions, and you can see that the rate of acquisitions has increased over time, especially after the great financial crisis. You can see that 2011, 2012, 2013, they just started going on a rampage. And then in 2022, they also started buying more, quite a bit, you'll notice. And in my eyes, that's a good thing long run, but it's a bad thing short run. And I'll try to explain why. Because I think the industry was over-earning in 2021 and 2022. So I think they overpaid. But that's just me relative to what they normally would have paid. It doesn't necessarily mean it's a bad investment. It just means I think they had some catch-up to go through. And you're going to see some more deleveraging of efficiencies in the short run, which the market's probably picking up on already, which is why the share price is already down, why I'm doing a video, because it looks more exciting than it has in the past. In terms of what's kind of interesting, unique, they do have the independent contractors, which are the dancers, so they're not employees. This could be a key risk over time. We've seen a lot of crackdown, say on like Uber versus taxi drivers type of stuff. Who's an employee, who's not. kind of thing. I don't think that's a key risk here. It is labeled as a key risk, to be clear, the 10K, but for my personal investment, it's not a huge deal to me. But it is worth bringing up that that could be something that happens at some point in the future. And you can see a whole lot of the employees are hourly, not salaried. This is the key risk to saying their current dancers are labeled as independent contractors. What's currently happening is you can see they're allocating a decent amount still to Bombshells, and we'll kind of go through. They do have a casino plays here, but we're not going to go into details because for our purposes, we're still backwards looking to see if we're getting a good deal relative to itself. The casino one does look interesting, but again, we're not going to get into it for the purposes of today's video because it's already going to be a little bit long. So what does the company do with its cash flow? Well, there's two things I really like, and there's one thing I'm not sold on. And so I like this M&A tuck-in where I understand it very well because I've seen it before in other industries. Like I said, you're just buying that cheaper mom and pop, and you're just tucking it into your own business, and you're most, like, say, alimentations appear, they're harvesting synergies. This slide doesn't say that. They're just playing the EBITDA multiple game. Basically, I would argue the access to capital in this space is rather restrictive, which means whoever has the cheapest cost of capital is probably going to win over time. That's not necessarily true, but that's how I view it. And one of the things I'd argue is that whoever has the cheaper cost of capital probably has a better EV to EBITDA multiple and can therefore use their share price to buy out the other ones even at a bigger disconnect. And the bigger the gap between what you're buying and what you're currently trading for, that's kind of like your momentum gauge over time to how quickly you can expand your business by acquiring others. So it's kind of like that tuck-in multiple play. And basically, the more they tuck in, the quicker investors like me would get that trade up in multiple as it gets rolled into the higher multiple business. Now, there is another interesting thing called share buybacks. I love share buybacks. So what I would have rather is they held the cash and then started buying clubs right now when the clubs are probably, and maybe the restaurants are more struggling, right? I would just view that as an easier time because you know that you're not overpaying for something that may or may not be sustainable because of that COVID reopening surge that we saw, right? Experiences done very well. I would call nightclubs experiences, right? That's why they command the multiple and the gross margins that they do. And we're going to go into the financials, because the financials look really good, especially over time. So I'm not hitting the company for that. It's just I just want a better price. And then they do the Bombshells, which I'm not sold on. And I'd like management to either talk about why would they allocate capital here when they have these other two that appear superior to me over time. In terms of sales mix, it's largely alcoholic and entertainment. They do have food. And again, I'd say half the food is actually the Bombshells business, kind of like that Hooters-esque kind of thing. Both serve alcohol, but the margins are just, in my experience, always superior in alcohol and always superior in entertainment services. And the company does give off a lot of cash flow, and so that's important in the long run. It's still profitable right now. You can see, even during the pullback that we've seen in quite a lot of other industries so far in spending, especially discretionary spending, we've seen nightclubs do quite well. Now, this includes some of the stuff that they have acquired. So you can see that here, the store count going up by 9, which you can see this margins have held in fairly well. We have seen some deleverage, but relative to the Bombshells business, it's held up very well, I'd argue. And this is just a picture of the Bombshells. Like, if you're trying to see what it is, it's kind of like, I view it like it's like a restaurant with probably more attractive waitresses or waiters. It's kind of how I word it. But you can see here, it's very clear when I compare this to that. One is very much holding in, one is obviously in decline. And you can see total revenues down. So despite putting more money into the Bombshells business, you have revenues down in 2 years, even though you have more locations contributing to revenue. So their efficiency per site is obviously weaker, and it has been weaker almost consistently for the last 2 years. So I view that as a weakness and why I want a better price. The debt-wise, I did see some comments that people thought the debt was high for Rick. I don't find it high, per se. It's not as low as it was the year before. So in rate of change terms, that's bad. But in terms of the absolute level, I think it's still fine. They can still afford it. The maturity schedule is fairly spread out. They do have one balloon payment in 2025. For most part, I mean, it's only $15 million a year, which the company could afford. And then if they needed to, they could always roll this. So I don't think the refinancing risk is high here. And we are seeing lease as a percent of the revenues go up. Again, that would imply negative scale. So either they're not pushing price enough on their fixed asset line, or something else is happening here. Maybe the recent acquisitions, like I said, maybe they overpaid for them. And I should say to the bank's credit here that the average interest rate is actually held in, it's actually down versus 5 years ago, which is very interesting. So their ability to attract capital has actually improved over time as the business has grown, which would imply scale. And that's despite currently rising rate environment and the fact that they've increased debt, which could, in theory, would lead to some type of expected return for a credit risk if you're over a debt, and so far that hasn't really happened. So I think the debt level's fine. It tells me that they're not over leveraged. That's so much so that the lenders are afraid to lend to them. That's probably the best way to word that. You can see here, this is the breakdown of the weighted average interest rate. So the WACC, but it's just for the debt side. And you can see on a secured, it's not too bad, 5.4%. But you can see unsecured 12% here. So whatever securing these assets, probably the property value. So obviously decreasing the access to capital. You gotta imagine that people that are small, like a mom and pop, must get really screwed if they go to the bank to try to get a loan for their business. I would imagine the interest rates had to be quite high for them. So this is probably one of the reasons why Rick has grown like it has, is because the better access to capital it has, the better the acquisitions are going to be that they make over time, especially versus whatever they're acquiring. And that's why I think the tuck-in strategy is superior to, say, investing in Bombshells. Before we jump into the number, actually, let's just do it. Let's just go through the quarterly, because that's the reason why the share price is relatively cheaper. We are seeing decent revenue growth, mainly in alcohol and service, and we're seeing an inability to push inflationary cost on food. Again, this skews heavily to Bombshells. It affects both of them, to be fair. But you can see that which one's growing the least, and actually negative growth over year, despite having more stores open and despite making $60 million in acquisitions. It's food. So that shows up here. There's a couple other slides that I'll point out that make it very obvious. You can see though GMD is still up 8.2% year over year. So the company is still in growth mode, but we are seeing pressure on salaries and on SGA. And then we're seeing, because they made more acquisitions, you can see depreciation up. With interest rates rising as well as more debt, you can see there's expense up. So you can see they're kind of getting squeezed below the line. So like GMD looks fine, and then you can see underneath it though, you're seeing deleveraging. So that tells me they need to push price or they need to cut costs. It could also tell me that they overpaid for some of the recent acquisitions. That's not necessarily true, but that's something I could suggest. But overall, year over year, you can see net income down about 35%, and the share price is down almost in line, 27% year over year. So it's reacting. Basically, the market's just extrapolating whatever's currently happening. Right now, the business is worse year over year, so the share price is going down year over year, and until that inflection point happens, it's likely to continue. So you can see equity EV, we're about $200 million cheaper year over year, which is nice. So we are getting a decent deal to itself versus last year, just in terms of share price. But again, it's because the underlying performance of the assets are also in decline. In terms of the balance sheet, it's not overly indebted or anything like that. So you do have $243 million in debt, only $23 million in cash, so your net debt's $220 million. But again, your EBITDA run rate is probably something around $90 million to $100 million a year. So you're not over leveraged by any means, but that's not zero either. So it's something to keep in your head that it could be a risk at some point. It's not a risk right now, but it could be. In terms of the asset quality, they do have quite a lot of goodwill. This always happens when you're a tuck-in play. Whenever you overpay for assets, you have to put it in goodwill. So that always happens. They also have to acquire licenses, which is also a place for abuse that I've seen in the past, especially on the cannabis side during the cannabis years. So that's something to keep in your mind too. It could also be written down. Now, those aren't cash things. They've already spent the cash. It's actually a way to lower your tax burden after the fact, but the share price never likes it when you do impairments. So sometimes you can either get entry that way. So that's something to keep your back of your head as well. Usually when I see high intangibles, I view that as a bomb waiting to go off, where they have a big impairment in the future, shoots down the net income, and I get an easier buy because I know it's not a reoccurring thing. But for some reason, I find markets react to that when they happen. What else is there? You can see free cash flow is still positive in terms of the traditional CapEx, but not after the acquisitions they make. That's why they've had to borrow debt, is to make the acquisitions they did. Normally, the company has actually been buying back shares. I think they had more than 10 million outstanding. And when I started looking, maybe it was only 11 million shares outstanding. Now they're only at 9.4, so it does go down over time. Lately, it hasn't. They've also started share-based comp, which is increasing shares outstanding year over year instead. So it's going the opposite way here as the company decided to use its cash flow to make acquisitions. And in doing so, made acquisitions that generated less net income. So you can see that the business is stressed year over year. Rate of change is negative. But you can see in terms of, is it priced in so far? So far the weakness is overpriced in versus the last year. So even accounting for the weakness, it is cheaper. Now it's not even a full turn cheaper in EBITDA, but it is getting cheaper, which is nice. These are just notes to myself if you wanted to freeze it and read it. But basically, I've kind of talked this to death already. When you're buying clubs at 3 to 5 times and you're trading at 8.5, you're going to continue to make money for shareholders over time. That's kind of the crux of this investment over time and why it's done so well for itself. Now, what I mean it's done so well for itself, here's the annual, which I think sets the page. So this company's gone from only like 74 million a year. I mean, maybe you're getting 50 cents earnings power, 80 cents of earnings power, and then all of a sudden, call it 8 years later, 5 years later, you're at $1.11, 134 million in revenue, right? And then fast forward today, you're double that, and you're at $5 in earnings power, right? And the share outset's having this going down slowly with the free cash flow, but a lot of the free cash flow goes back into the business, either through more acquisitions from nightclubs or to this bombshells thing, which I'm not selling. But you can see over time the business has done quite well. It's growing quite well. So the proof of concept is definitely there. Just think that I can get a cheaper price. On the latest call, our latest quarter, you can see revenues is very dominated by nightclubs. 62 million of the 77 million is nightclubs. Despite CapEx almost, well here, here's right here, my Y comment. You can see CapEx 11.9 million going to bombshells and only 14.5 million going to nightclubs. The thing is, why would you put 11.9 million here when the company or the bombshell segment is only doing 42 million so far in 9 months? Maybe they do 60 million. Right, you're putting like 1/6 of revenue back in the business in 1 year for a business that's in sharp decline year over year versus nightclubs, which is holding in so well relatively. Like you have nightclubs contribution margin down 10% year over year, and you have bombshells contribution margin down 44% year over year. So it's a huge decel. Maybe that's because Texas, maybe there's harder comps there. I don't know, but it just screams that the nightclub business is superior in times of consumer stress. At least that's what I would argue based on what I can see. On the SG, so we are seeing inflation. You can see that really here. Utility is probably the purest example of just inflation. And this hits every business, and the ability to push prices is one of the ways that they can mitigate it. Probably the best way they can mitigate it. And we see them push price. It's not so much in food so far. We've also seen, like you see a shoot up here, security by 50% year over year in the quarter. We've seen an increase in theft, so times are tough out there for consumers, so you'd expect security spend to increase. So we're seeing that here. And here you have advertising and marketing. So in order to drive up demand, sometimes you need to entice people with more promotions. That also hurts margins, so it shows up here. So you can see one of the reasons why, GMD might be going up. It's not hitting the bottom line because they have all these extra costs that they still have to push through. So I'd say that they pushed through a part of it, not all of it. And that's why the thing's down year over year. I did find this part interesting. So related party transaction, the CEO is actually personally guaranteed 120 million of a commercial bank indebtedness. So when I go to that total indebtedness that they had on the quarter year end, just call it 243 million. Just say half of that is personally guaranteed by the CEO. That's very special. I've been trained to basically if you're ever a CEO, you should never personally guarantee anything. So the fact that he does this says that Buddy needs this company to work is probably even more incentivized than a huge ownership position. He does own 7% of the company, but this is big, right? This is personal. So like, if the business were to go under, the debt holders could go after him personally. So that's worth bringing up here. It does mean that he is aligned, and like he could lose everything if this company goes under, which is different than just being aligned in terms of equity. Like I just lose what I put in, right? He could lose his home, like anything personal. It's weird to see in a public company. So that's why I thought it was worth bringing up. And here again, I can pick on this. Just allows me to pick on bombshells when I see food down, right, year over year, and the other ones are fine, pushing price and growing. A part of that is the acquisitions, but again, this one is down for a reason, and it also correlates because nightclub or Bombshells has more food as a percent of their business. So I'm not a fan of that. And then the Goodwill side, to pick on the latest one, you see 66.5 million for this Baby Dolls Chicas Locas acquisition on March 16th, 2023. You can see that. So right off the bat, Goodwill basically is whatever you overpaid, which it always happens. It's fine, but overpaid by 10 million there. And then they argue that the licenses are worth 27 million and trade names worth 9.4 million, which you may or may not agree with based on the results that these acquisitions have put up since they made them. You would argue that they've overpaid for them. Another way to view that, which isn't traditional, but it's the way that I do it, is when I see the Goodwill shoot up, call it by 40 million or 22%, but I only see 10% jump in revenue, technically, in terms of the Goodwill they've overpaid or the intangibles they've overpaid for versus their long-term average. Now, that doesn't necessarily mean they're expensive or cheap, it just means they paid more than they normally would have, at least traditionally speaking. Now, it's not necessarily true. Maybe it's just recession and they're going to pick back up at some point. But if I were to look at it just year over year, it would imply overpayment. Or at least that's how I would treat it. And that's how a machine would treat it too. So that's why I think the share price is also under pressure. I talked about ownership. So CEO does own about 7.5%. We did start seeing ADW Capital start trimming. That's Adam Wyden. I think he's on the call quite a bit. I listened to them a few times. I've been shadowing this company for a little bit to try to get a better price. And I'm still trying to get that price. And then we did see Troy. I think he reduced his position by about 20%. There's quite a bit of insiders. I would say there's definitely more retail because retail holders, because it is a pretty unique asset that you can publicly trade. It's not very often you have nightclubs. I think that's also a way that I could get a better price is if people panic, they see a loss, they sell it after the fact, right? Most people actually, like a retail, they see the loss and they'll sell it because the price dictates the narrative. We did see that the payment for the executive team has increased each year, and it increased into this weaker year. So they're getting paid more while the share price is in decline, which I don't like to see because I like to see alignment. That's also one of the reasons why there's negative scale year over year is because they're paying themselves more despite a lack of shareholder improvement over the last, really since 2021, since they were over-earning. And remember, they made all those acquisitions in 2022, probably at a time when they were over-earning, like the things that they acquired, because of this whole reopening theme to experiences. That doesn't mean they're going to keep going. Like, it could recover again, but I'm just hoping that we get some type of emotional response that gets barely below the Bollinger Bands, where I have a lot of retail names that are just destroyed, right? In the last bit. So I'm really hoping for this to crack. Now, I don't think it's going to ever go to like that COVID panic low, especially when the company's still putting up more than $1 in earnings power a quarter, right? That's $4 a share in earnings. Put a 10 times multiple, and now you're at $40, which is, I'd argue, cheap for this type of growth. So that's where I'd ideally like to start a real position in, $40, but I mean it's at 57. During 2018, when the company was only putting up $2 in earnings power, it was at 30. So you could argue 60 is pretty fair at $4. So I'd say today's a fair price, and I just want a better price. That's how I'd run up today's message. I do own it because I'm trying to get into it. I think it is, over time, it's going to keep growing and doing well. I'd be more confident in it if Bombshells didn't exist in the business. But maybe there's something there I don't know. Maybe that's a way that they're getting access to capital, right? Or cheaper access to capital. We already talked about the ownership, and we talked about the recent insider sale. So those are also legs that, like, why would I buy now when the person with a 10% holding is selling? Albeit it's a small amount, but still it's not a buy. And that's pretty much what I wanted to say. It is an interesting asset, and I think over time it's going to do quite well. I just don't know how cheap it gets during this recalibration phase when people are still pulling back in discretional spend. And this is discretional, though it's a cool asset to look at, and the time to buy it would be when discretionary is pulling back. I just don't know how cheap the asset gets. It's one I'm looking to buy in between now and $40, and then under 40 it gets very, very easy here for me to buy. All things equal, especially if Bombshell stops eating up capital, I think would be better utilized buying other clubs, as they're also probably under pressure at the same time this club is. That's what we saw with Alimentation Couche-Tard. They actually held off on making acquisitions, and then once Europe started really feeling the pressure last year, they just started unleashing capital into Europe, buying up all these gas stations. And that would be what I want for these guys too, right? Just once the mom and pop nightclubs are under pressure, then they just get in there. But it looks like they kind of jumped the gun in 2022, and I think so. It's going to kind of slug the growth, and it'll probably give me time to get into this at a better price. Anyway, I'd like to know your thoughts on Rick's Hospitality. It's a fun asset to look at. It's definitely unique. And I figured I'd get it out for the long weekend in Canada for Thanksgiving. So have a great rest of your weekend.